Hi, I'm Laura Suter from AJ Bell, and with me is Andy Bell, Chief Executive of AJ Bell. The company's just released its interim results. Andy, congratulations on a strong set of figures. So revenues are up 17% to 50.1 million, and profit before tax is up 27% to 17.7 million. How do you feel about the results?
Well, it's our first set of financial results since the IPO. We've had two trading updates, but this period runs from 1st of October last year to 31st of March. I would say been a very strong set of results, broadly in line with analyst forecasts. And I think what it does do is just remind people that we have a very robust business model that can succeed in all different investment climates.
And what's been driving the growth of the business?
The engine room of our business is always the customer numbers and the assets under administration that they bring with them. In the 6 months to 31st of March, we've seen customer numbers increase 9% in the half year, up to about 215,000. We've seen net inflows in the 6 months of about 1.8 billion, and we've seen the assets under administration rise 3% up to 47.7 billion, which, although sounds fairly modest, in that period the FTSE All-Share fell 4%.
And so why are these figures so strong?
Well, I think it's really focusing on what we're about. The core of what we do is we help people to invest. Real focus is on making our platform the easiest platform to use in the market, and really by doing that we will focus on three things. It's price, making ourselves the most competitive, service, providing a first-class service, and making sure we've got all the functionality and support and guidance that our customers need.
The board's declared an interim dividend of 1.5p per share. Can you explain a bit more about the dividend policy?
Yeah, well, as a business, we are very profitable, as is evident from the results. We convert that profit to cash very quickly. We have a very strong balance sheet, materially debt-free, and our dividend policy is really made up of two strands. Our interim dividend is broadly set at 40% of last year's totally ordinary dividend, whereas our overall dividend at the end of the year is targeted at being 65% of the after-tax earnings in that year. Any business like ours, you would expect over time to build up a surplus. That surplus, part of it will be used to be reinvested in the business, but over time one would expect any surplus to be returned to shareholders by way of either special dividends or any other means that may be appropriate at the time.
So how has life been as a listed business? Has it been very different?
It's certainly nice to get back to running the business. The IPO last year was a slight distraction. As I said to our staff on many an occasion, the IPO, all it brought was a share price. It's not changed the way we think about the business. It's not changed the way in which we run the business. And the challenge for us now is we've been running this business for over 23 years. It's making sure we keep that long-term thinking and don't fall into the trap of running the business based on quarterly trading updates, which you can see the market can sometimes drive you towards.
AJ Bell's campaigned on issues in the past. What's the areas of focus for the next year?
I spent a bit of time speaking to the regulators, speaking to the government, the tax authorities, and really the heart of what I talk about is about simplification and fairness. There's two areas of probably 5 or 6 we're working on at the moment. One is in simplifying the ISA regime. Currently 7 ISAs at the moment, far too complicated, different rules for each one, all used for different purposes. And then secondly, is for those of our customers who don't have the benefit of having a financial advisor, it's enabling us to give them guidance and help with their investments without us being dragged into giving them a personal recommendation, which brings with us liabilities and costs and challenges that we just don't want as a business.
And finally, what's the outlook for the platform market more generally?
The platform market is still very strong. If there are any headwinds out there, there's been weak investor sentiment over the last period, partly driven by Brexit, partly driven by wider uncertainties across the globe. We've also seen defined benefit transfers slow down, which is as we anticipated before the IPO, largely driven by regulatory pressures. But if you look at the underlying structural growth in the platform market, it's still a very strong positive story. All the supporting factors, people are living longer, people need more savings in retirement, and the fact is they need to sort their own investments out either themselves or with the benefit of an advisor, and we are uniquely placed in that we're one of the only platforms that offer both an advised platform solution and an execution only platform solution at scale in the UK.